Hey guys, AKIL'S here. Welcome back to the Trading Coach Podcast. Today, we're going to talk about digging into the data and how that can help with our decision making when it comes to trading. We're also going to talk about how some great ideas in theory may not be the best in actual practice. Now, this is a video edition of the Trading Coach Podcast, so make sure you head over to a platform where you can see me. I know Spotify shows the video version. I know I'm going to put this on YouTube as well. We are going to dig into the charts a little bit, so it may be worth viewing in a visual capacity if you're able to. If not, you'll be able to get by as well. I'll do my best job at explaining. Also, just a reminder for the YouTube audience, I have not been posting the non-video versions of the Trading Coach Podcast on YouTube. So if you're asking yourself, how come I missed episode this and that, they're going to be on the podcasting platforms only. That way we can kind of clean up the YouTube channel and not overload you with content. So today's topic comes from a question, a great question that I recently got from a trader. I'm going to start off by reading it to you if I can find it on one of these many monitors that I have. It says, Akil, what's up? I hope all is well. I listen to your Trading Coach podcast almost every day, and I'm currently on episode 400. You're almost caught up. And it's helped me so much with getting through my backtesting stage. You have no idea, praise hands. I don't think you have an episode where you don't mention backtesting. I'm glad someone loves the broken record, right? I do have a quick question for you, however, if you don't mind. I've searched many places, but I can't find the answer. I believe I have a profitable trading strategy that's proven to have an edge, but on one particular day, it loses more than it wins, resulting in a negative outcome for that day due to my risk-reward ratio. So, my question is, when I decide to go live after completing my backtesting and my results remain the same for that one negative day, should I avoid trading on that day to potentially increase my win rate until my data shows a positive trend for that day? Or should I trade that negative day as well, no matter what, and continue executing my trading plan? There's a second part or a response. I responded to this trader and then they responded back with a second question. We'll get to that later, but let's focus on the first one. So backtesting, just a quick recap so we can keep the streak alive of talking about backtesting in every episode. We actually, we're running a workshop right now. We actually covered backtesting in today's session, and we're telling the traders how backtesting results are essentially your Bible, meaning that every answer or every question that you have about your trading can be answered in your backtesting results. It takes a massive amount of time, but you are really creating and building something that will last the rest of your trading career. And Jason had a good comment this morning. He said every time he talks to a trader and they're like, why do we have to backtest? Blah, 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 blah. And he asked them why not. He's never gotten a response. And there is only one response for not backtesting it. It's because traders are lazy. Traders do not want to invest the time, the energy, and the effort into doing what is necessary into becoming a consistently profitable trader. So shame on you, you lazy failing trader, you. But in backtesting, as we're acquiring data and we're answering all the questions that we have, what we end up getting is a summary of really every single scenario that we can think of, more data than we know what to do with. And when you're looking at optimizing your business, optimizing your trading strategy, we're looking for any way that we can increase our edge. It could be maximum favorable excursion, where we can increase our targets a little bit and win a little bit more in each trade. It could be maximum adverse excursion, where we can reduce our stops a little bit just to become more profitable. It could be a filter. It could be this. It could be that. And something that can also occur is noticing a trend, whether it is a day of the week, whether it is a certain month, whether it is seasonal, where our trading is not good or not optimal. And in this trader's specific circumstance, they are noticing a trend that says, hey, blank day of the week, I don't know what day, we're going to call it Monday, right? Monday, let's call it Friday, right? Friday, end of the week, get an early start to our weekend, right? This trader is saying that Fridays, my results in my backtesting show me that historically, over all these testings, over all these pairs, there is a consistent pattern, right? And it's important to make sure you're diving into it as a whole of your portfolio or just an individual pair. But this trader is saying that as an individual or as a whole portfolio, it shows that Fridays are negative and that my trading would be more profitable if I didn't trade on Fridays? And the question is, what should I do? And it seems like a simple answer, right? The simple answer is don't trade Fridays. But I understand why the question is being asked, because we talk about consistency in our plan, consistency in our approach, consistency in our execution. If all of a sudden we are doing everything we need to do, but on one day we're deviating, well, how is that consistent, Akil? Well, it is, right? This is called a data-based change, right? We are making a change in our trading, and it becomes a part of our trading plan. So we are staying consistent with our plan based on the data that we have. When I was a day trader, I would never day trade Mondays. I would never day trade Fridays because I just didn't see the point in it. Meaning that when I looked at my results, Mondays were typically break even, Fridays were typically break even. So there was really no point in me trading those 2 days. So what I did was I used those days for other reasons. I would use Friday as an off day, or when I started doing the trading business and the coaching and stuff like that, I used those as days to work with clients, to catch up on business, to do kind of the behind the scenes stuff, because there just wasn't a point. So yes, I do think it is a smart idea to not trade that day. You can always keep track and journal and go back through it as you do your trading reviews and see what trades were triggered, and maybe trends change, right? That happens as well. I used to have a streak where September was a horrible month for me. Every single month, I would just get beat in the face in September, and eventually the market conditions changed. September stopped being as directionally volatile as it used to be, and I added it back into my portfolio. So, that's a thing as well. So you can always keep track of it and see if it changes over time. But initially, yeah, nothing wrong with cutting out that day. Give yourself a day off. Give yourself another day to back test the next thing you're working on and give yourself some freedom. Ultimately, that is the goal of trading. So why not start now? Now, the second question, I have a little bit of a different opinion on, right? I agreed heavily with the first one. Yay, do it. The second one, boom, no, right? Do not do it. And let me read that to you. It says, Akil, thanks for the reply, blah, 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 blah. Now, my last question. If I feel there's enough data on this day, would it be smart to deviate and trade the opposite just for that one day? In other words, should I use my data to establish a rule? By the way, I have a mechanical system based on this data, so I'm trading the system consistency like clockwork. The one day has resulted in negative $8,000 of loss based on 2 years of data and 125 trades. If I have done the opposite, I would be up an extra 8% over these 2 years. So the question is, do I make a rule and stay out of the market on this day, or should I make a rule and deviate based on this systematic approach? Now, I'm going to take two approaches on this. One, and the general guideline disclaimer that Akil has to say, do what your data tells you to do, right? If you have back tested it and you have ran the numbers and your numbers show you that it would be profitable, then I'm not going to stop you from being profitable, especially if it's a systematic, and when they say system-based, I don't know if they meant literally system-based, like a plug-and-play mechanical system where you program it and you sit back and it does the thing while you sit back and count the money, or if they meant just like really, really rules-based, like indicator-based or something like that, because that will make a difference as well. But if it makes money, then trade it. But one thing I would be aware of when it comes to the idea in general, right? And this is the part that I'm gonna poo-poo, right? I don't know why I keep doing that. It's a thing. Maybe it catches on, maybe it doesn't. Maybe I go viral, I don't know. But anyway, I did it, right? So here's the thing you need to be aware of. And I get this from a lot of traders. A lot of traders will test stuff. They'll have ideas and they'll put it through the ringer and they'll say, hey, it didn't work. But since it didn't work, if I just did the opposite, it should work, right? That reminds me of the time I told you this guys in the recent podcast. I was on that 17 trade losing streak where I couldn't win to save my life. And I was running a live room at the time, and the live room traders they were messing with me, right? Making me cry, whatever like that. But I would be like, hey guys, I'm getting long euro dollar. And they'd all be like, all right, everyone get short, because if we just do the opposite of Akil while he's losing, we'll make money. And in that case, they did make a lot of money because I was pretty bad for that stretch of time. But in all seriousness, it's not that simple. And I want to head to a chart to show you why. And again, the idea is that, hey, I have a chart in front of you. This is actually the euro dollar trade that I showed you guys multiple times on the YouTube channel. So if you want to see kind of the behind the scenes of this, make sure you watch the recent videos. But let's say I have a trade like this. In my trade, I measure out a risk and a reward, right? For me personally, my risk reward always has to be 1-to-1 minimum, meaning that I have to make at least as much as I'm willing to lose. Ideally, I would be more than 1-to-1. I like a 1.5 to 1, a 2.1, a 2.0 to 1. Like those are really, really great numbers, but minimum of 1-to-1. And if this is my normal trade setup, the one that is losing on this day, it's going to have this positive risk reward. However, if I come in and just think I'm going to do the opposite because, well, if I get stopped out all the time, I should just get long. Here is something we have to consider, right? I'm going to try to talk and type at the same time and explain this to the audio only version, right? We are flipping pretty much our risk reward ratio. So in the case that I'm showing on the screen right now, it's a 1.621 based on this short. If I were to flip it exactly under the theory that, hey, I'm just going to do the exact opposite, well, here's what happens, right? I now have a zero or an inverse risk reward where it's my reward is only 60% of my risk. And that could potentially be a problem, right? And well, you say, Akil, well, why can't it be more? Why can't we just stretch it out to a higher level to make it that 1.6 to 1 or whatever it may be? Well, remember, the theory is that we're only taking targets, right, to the point where we got stopped out, which is right here. If we were to take targets to this new point that we created, who's to tell if we actually got that high or not? We can assume that maybe we got that high because we want to, but there's no actual proof behind that. So if you want to test that, you've got to go through the entire testing of not just saying, oh, I'm just going to reverse everything, it's going to be all right. I have to actually test the new changes that I'm making. Now, again, if we go back and say we're not making any changes, we're keeping that inverse risk reward, then we need to understand that our numbers and our win percentage needs to flip, right? If I have a 1.6 to 1 risk reward on a regular basis, I can easily win one trade and lose one trade and be in profit, right? I can be a 50% trader and make lots of money. That's just the way risk reward works. However, if I have a inverse risk reward and I still win one trade and lose one trade, all of a sudden I'm losing lots of money. So I really need to win twice for every one trade that I lose in order to be a profitable trader. So you see how it's a different game. Now, again, I'm not saying that this isn't profitable. And the trader that we spoke about ran the numbers, and I would advise that you guys did the same. But the point that I want to make is it's not as easy as saying, oh, this thing stunk, so I'll just do the exact opposite and it will make profit. It is a different game, right? Our stop loss is a lot further away than it was before. Our target profit is a lot closer than it was before, or what we would want it to be, right? We're doing an entirely different system, and you need to test that entirely different system as its own unique system and not just try to shortcut it. So I hope that made sense. Believe it or not, this is a very common question. I just never did a podcast episode on it. So this is why I have this platform, so I can read stuff and be like, oh, I got to get it out there and get it out to you guys right away, and hopefully it was helpful in your trading. Now, before you go, something else that is helpful in your trading is a trading computer. If you're interested in learning about what needs to be inside a trading computer, I've got a free trading computer guide for you. I'm going to put a link in the show notes below. You can click on it, you can fill out your email, you'll be sent a buyer's guide, you get a discount if you buy something, or you can just look at it and get an idea for, hey, if I'm getting a laptop, if I'm getting a desktop, this is the type of stuff I need if I'm serious about being a trader. That was a free gift to me by my buddies at Easy Trading Computers, who I've used twice in my lifetime and have enjoyed both times, and I want to give it to you guys as well. So check the description box for that. And until next time, plan your trade, trade your plan. See ya.